Good morning here in New York, Aisha.
Hello, everyone. Yes, I'm joining you from London, from lovely Mayfair here at the Browns Hotel. But I was just actually speaking about our blockchain for impact model here with some tech investors um, because we're really excited for what we're building here. So it's
Good.
nice
Well,
to be able to
listen,
hear
I want to offer a very brief introduction of who you are. You are the founder and CEO at Impact Vest, which is an impact mission-driven alternative asset management firm focused on a purpose-driven economy and reimagining capitalism. Aisha is the author and creator of one of the foundational theories and models of using blockchain protocols to optimize impact investing towards frontier and emerging markets. And the blockchain technology has the ability to facilitate real, transparent impact investment resulting in sustainable outcomes. And with its immutable public record and of on-chain activity, impact investment can truly achieve global change for our sustainable future. And Aisha, the floor is yours.
Okay, thank you. Yes, it's really a pleasure to be here speaking with you about blockchain for impact. We truly believe that this is the next evolution of impact investing. We've been able to speak to our own portfolio companies, other fund managers in VC, particularly in pre-seed and seed stages, who invest in the global south. And the need for transparency in sustainable and impact investment, particularly when we're focusing on impact targets that may be outside of maybe our Western-based models, is quite important to be able to build the next evolution of impact investing. So what I wanted to start with today is the focus of impact investing as a main portfolio strategy. All right, and we can move to the next slide. Okay, and this is what we have to focus on even before we get to the blockchain for impact model, right? Because when we focus on the growth of impact investing as a main portfolio strategy, what we have to focus on is how do we actually measure impact? How can it be verifiable? And when we think about where we have the most impact with our capital, which is in the global south, if you think about investing $1, a euro, a pound, it goes further in the global south. And that's actually where we see, if we speak about the African continent and other emerging and frontier markets, we see the effects of the climate crisis much more drastically. And this is where we have to focus on, well, when we deploy our capital, how is it measured? How is it verified? How do we actually know that it creates a positive impact at the moment of deployment? So even before we get to the usage of blockchain technology, it's important to focus here, right? How we are investing in terms of family wealth, right? And so we see that rather than the focus on ESG as a risk management strategy, what's starting to happen is that impact is being used to be able to measure how exactly capital is being deployed and being measured through positive impact throughout an entire portfolio. So the models still have to be created to measure that positive impact. When we speak about most ESG measurements and criteria, many of them tend to penalize companies based in the global south, right? They may have great products and services, but they have market risk, currency risk. They have multiple risk around their company. We speak to many of our portfolio companies that say that many of them have to place their supply orders in US dollars, but yet they receive customer orders in their local currency, right? So when they go to pitch to investors, the fundamentals of their business already probably don't match up to a very similar company that's based in the West. And so the challenge to be able to evolve impact investing is to be able to measure and verify those nuances to level the playing field, right? Because unfortunately, we can't do a lot about market risk and other macro risk, but what we can do is acknowledge that the landscape looks very different for companies based in the global south and for those facing the most urgent of our sustainability challenges. And we can go to the next slide here. So focusing on impact investing, we also see that we can start to create more advanced portfolio strategies when we start to focus on impact investing as the primary portfolio construction vehicle, right? When we start to focus on what is exactly the positive impact that companies are creating within a portfolio and how can we measure it? When they create their products and services, what is the effect on the community, on their stakeholders? As investors, when we deploy our capital, how do we include this when we have to report on the impact of our funds? I would say here in the EU, I'm in London, right? But we have SFDR. How do we actually report on this as fund managers? We have to be able to assess the impact of our underlying portfolio companies. In the case of our fund to fund, we have to ask our fund managers what is the impact of their fund, their portfolio companies. So the reason that we started to create this model was to be able to track the transparency in our own portfolio and to be able to recognize that when we are focused on the local context in the global south, the impact targets look very different. For example, in one of our portfolio companies, they asked, well, how do we actually measure the impact of creating jobs in the informal market? And this was a really interesting question for us, because then when we go back as investors, we say, well, how do we report this within our own fund, right? But these are very important impact targets and metrics to be able to measure. Because if we can't measure these impact targets, it becomes very difficult for these companies to fundraise. It also becomes very difficult for the funds who are supporting these companies, if we kind of talk about a fund to fund, to be able to deploy their capital. Because at the end of the day, they need metrics to be able to justify the deployment of their capital. So that's what we're focusing on here, is if we have impact investing becoming the primary portfolio approach for many sustainable investors, well, how can we actually track this impact? Because what the end goal is for the portfolio companies to be able to raise capital based on the impact metrics and based on the amount of positive impact that they're able to create through their products and services. So this is really the basis of utilizing blockchain technology to measure and verify impact, because with the growth of impact investing and in the global south where we can have the most amount of impact, to be able to close the SDG financing gap, which is now more than 2.5 trillion, what we need to be able to do is track the deployment of capital from the moment it's deployed to exactly the funds that it's deployed to, or the portfolio companies that are then able to scale positive impact in their products and services. And the question is, how do we make investment transparent? And this is where the usage of blockchain technology comes in. And so we can go to the next slide, please. So the main question here is efficiency and transparency in impact investment. When we speak about the global south, there is a certain lack of data, even when we speak about the impact investment universe in general. The main question is data. So how do we verify it? How do we measure it? How do we know that it's trustworthy data on an investment that we want to include within our own portfolios, right? So it is really the accounting of impact. And without credible data, it becomes very difficult to make an assessment on what is a credible investment. And if, as investors, we're not able to assess the right investments for our portfolio, then then we are not able to deploy impact capital efficiently, right? And also, one of the challenges is the attribution of impact, right? And so the double counting of impact. So one of the uses of blockchain technology here is to be able to make this transparent, right? So that we can avoid the counting of impact twice, and we can actually make sure that when we deploy capital, we actually goes exactly to where we strategically want to deploy it within our own portfolio company, or if it's a fund of fund, right? So it really is the allocation of capital going strategically where we want it to go, and the impact targets and metrics that are coming back from the portfolio companies, like I gave the example of creating jobs in the informal economy. What we're particularly focused on is how does impact look in local markets? Because if we're truly speaking about scaling positive impact, we have to recognize that there is no universal standard, that it looks very different depending on the context, the country, the region, the city, right? So this looks very different depending on what you're speaking about in terms of the vertical and the region and geography. So how do we actually measure all of these nuances in impact, right? There may not be a universal answer, but if we can make the deployment of capital transparent, we can get closer to how do we track positive impact that a portfolio company makes, and also making it easier for them to be able to fundraise and scale their companies. Because if they have these impact metrics and these impact targets that are tailor-made for their local markets, then they can go back to investors and they can show they have proof of the positive impact that they're making with their companies, right? And without this transparency, very much focused on companies in the global south, the SDG financing gap is going to stay, because many of our portfolio companies tell us that the metrics that they're judged by when they are fundraising are not built for their local context. Like the very good example I gave about having to settle their invoices or pay for their supplies through dollars or euros, and then receiving capital in the local currency, right? And there are many instances like that where if we can actually show the positive impact that they're making, we can start with positive impact. We can actually start to mitigate some of the other risk that maybe surrounds this company in the global south, right? So this is very important in terms of efficiency and transparency. The last challenge here is the roadblocks in monetizing impacts, right? And so one of the classic challenges of VC is that it's an illiquid asset class. But again, if we start to use blockchain technology, which we're experimenting with, because we're also experimenting with tokenizing our own funds, we can actually link this to the tokenization of our funds and start to create secondary markets, which is what we're working on at the moment, because we need to create liquidity in our VC investments. And you can please go to the next slide. So kind of backtracking a bit. So we think that blockchain-based solutions can definitely solve these challenges, these classic challenges in impact investing, because it's the transparency that we need. We need to create secondary markets. We need to build liquidity. So even beyond measuring and verifying impact, what happens is that when we start to place those impact targets and impact metrics on a blockchain-based ledger, right? And we're going to say it's a public ledger. There are many private blockchains, and I'll get to that at the end of the presentation, right? But we'll say that this is a public ledger, right? We can then start to link those smart contracts to tokenized funds that we're experimenting with, right? Because if we have the multiple challenges of it not being able to access liquidity, right, within private markets, not being able to measure impact, not being able to verify impact, then the SDG financing gap is just going to kind of hold steady, right? But what we're experimenting with is what if we can actually measure and verify impact within our funds, right? Or any VC or private fund can do this, and we can make it transparent, and then we can actually link it to our own funds. We automatically have a ledger, and we can actually prove the impact that we're making through our own fund, and then it goes in, and then we can actually build a secondary market around it because we've tokenized our fund. And I'm actually going to go into this with the impact tokens. Through tokenizing funds, you not only can build secondary markets, but you can actually prove the impact that you're making through your fund and the impact that your portfolio companies are making, and it makes reporting through SFDR much more easier. So, but this is really the evolution of impact investing. The incorporation.
Aisha, we want to see if there are any questions from the audience. So we're going to take our last few minutes for that. Any questions from the audience regarding blockchain for impact? I have one. They're related to the ongoing dialogue and discussion about central bank digital currencies. That's going on in the US as well as in other major economies around the world. Does that bring any more clarity or transparency to the kind of infrastructure that you're discussing?
Yeah, so that's a very good question, because one of the first things that we did was look for innovation hubs with the Bank of International Settlements. The Bank of International Settlements has really amazing programs on this. I've been to many meetings here in Europe, and they are working on this. They are working on how to, it's not only the CBDC, but how do you strategically track where your capital is going to and a transaction through a CBDC. And so it's not only the CBDC, it's the smart contract that's built into it, that you can start to track the deployment of capital. And it can be very transparent. It doesn't have to be only for impact investment. It can go towards any vertical that you would like it to go towards, fintech, and all of the other verticals. So what's very interesting about the growth of the CBDC is that basically we're speaking about the elimination of the middleman, right? And so as soon as you make a transaction, you see exactly where your capital is being deployed. Eventually, let's say within a couple of years now, you might be able to earn a return, or you may be able to invest when you do a transaction, right? So that's actually probably where a CBDC is going towards in terms of technology, is that when you actually link the measurement and verification of an investment to a smart contract, there are many different coding mechanisms that you can build within smart contracts. And the technology is not quite there, but eventually you'll be able to directly invest through a CBDC. The CBDC technology is very important for any blockchain for impact model, because the foundation is already there, and the CBDC is, we're just sort of experimenting from the CBDC foundation. But the very first place that we went is to the CBDCs, and really speaking with the Bank of International Settlements and the Innovation Hub, because that is, they are at the forefront of this technology.
Okay, well, thank you very much. Aisha Williams, the founder and CEO of Impact Vest, who's joining us today from London. And we really appreciate your focus on these growing markets, Aisha, and thanks for joining us at the 22nd Wall Street Green Summit.
Thank you, everyone. Yes, it's been a pleasure to speak with everyone today.